Hi, thanks so much for tuning in. You're watching VQ Prime. My name is Alex Matthew, and we're in an earnings conversation once again. This time we're in conversation with the management of Samvardhana Motherson International. Thank you so much, Pankaj, as well as Kunal, for taking the time. We've got the Chief Operating Officer as well as the CFO of the company joining in. At the onset, strong numbers once again, and for the full year, in fact, you've had growth of 23% in the revenue. EBITDA has grown by a third. I think it's looking fantastic, but could you lay the context for us? All of this is happening at a time when globally we're talking about uncertainty about growth, particularly in markets like Europe, in markets like the US. But you have a well diversified business, diversified portfolio. Could you lay the context on demand side for us? I'll come to you, Pankaj.
Well, see, we had a good year, and this is the first full year of the company after the restructuring. So we are very happy how the teams have performed and how the customers have supported us in this very inflationary environment and where there have been lots of ups and downs. This has all been made possible with their support. And also, as you have seen, that we have improved quarter on quarter. There have been some softening of the commodities, of the energy prices, but the cost related to people went up. There have been a lot of inflation even today in the developed economy. So, in that context, the operational efficiencies which have been improved and continue to improve going forward. That's the results are a testimony to the hard work done by all the teams around the world and the resilience, the nimbleness, the ability to react to the changes. So that agility is the key with which we work together all across the world.
Yeah, no, but so that's fantastic, and congratulations to both you and the team. But could you give us a sense, just to lay the context for this conversation, about the demand scenario that is playing out? You, in your analyst presentation, you talked about commercial vehicles improving, but then considering that your business operates primarily in the passenger vehicle space, could you give us a flavor of how the demand scenario is?
Yeah, we see the demand is still good, even in developed economies, whether it's in Europe or in US. We see that the demand is still lower than the pre-COVID level. So we still don't see much of a downside. We see that an upside. Demand in the Indian market has also been quite strong. The only area where we see the demand is at the moment a little bit weaker. Also, the emission changes are coming in that country is China. Apart from that, we see a good demand, and I'll hand over to Kunal to add something to this.
Kunal?
Yeah, that's exactly right. Overall, I think we do anticipate the whole industry to still grow. It's still at a much lower base than the pre-COVID levels, which was closer to the 93, 94 million. We are still at 83 odd million levels. So downside risks are, in our view, less. Upside potential is a lot more.
Interesting that you say that. And this is in the context of everybody talking about a potential recession in the US at the end of this year. And you're saying that resilience and upside potential is there at this point. I want to get to the margins because I see that there is a very consistent upward trajectory. If I look at the chart for the full year FY23, quarter on quarter, there's a significant improvement. What's driving that? Is it primarily, as Pankaj said, related to softening of commodity prices, freight costs going down, all of that?
I think it's a combination of multitude of different factors. When we started this year, we were hit hard with all the inflationary costs coming in at the same time. Whether it was interest rates, commodities, energy prices, everything started pretty much at the beginning of the year. Since then, we've been working very hard to work with our customers to try and share some of the pain along with them. We are thankful that we've been able to do it. We've also worked on strategies and value-added engineering elements to be able to reduce some of our own cost structures in order to cater to the new normal, so to say, we would put on the cost structure side. So all those efforts is what has gone towards trying to get an improvement quarter on quarter. That's what we highlighted every quarter, that you should be expecting to see a quarter on quarter improvement. Now, at the end of this quarter, I think a lot of that has happened. Going forward, we believe while many of the variables remain volatile, so our conversations with customers will continue. But a lot of the hard work is there, and now we have to reap those benefits as we move forward. So on an year-on-year basis, we still hope to do better than where we are right now. And then we'll have to see how the industry, etc., plays out.
But then do we see a consistency now, or do we continue to see an upward trajectory? Is 9% around what you would expect margins to come in at?
So the way I would see it is on a year-on-year basis, we are somewhere in the low eights. We should continue to see improvement from there.
Fantastic. You've been acquisitive in a very big way, and you've added quite a few businesses. A lot of them, and I'm taking straight from your investor presentation, a lot of them coming on stream in this current financial year. What is the impact that you will see on the numbers, on the operational metrics? How is that going to pan out, and what should investors watch for? Any one of you can take this.
Maybe I'll start, and Pankaj, please add. Look, we've announced 7 of them. The 7 are tantamounting to around about $5 billion on the gross side, $1.1 billion on the net revenue side.
Yeah.
All of these transactions on a combined basis is still expected to be cash EPS accretive. And this is all the presumption that all of these assets will be debt funded. So the current cost of debt, etc., is embedded in our EPS estimates associated with it. So we remain favorably positioned in order to integrate these assets and hopefully make it accretive on the EPS side for all our shareholders.
Pankaj, do you have anything to add to that?
Well, I think, Kunal, you have covered it well, and it brings us even more closer to all our customers, and that brings more opportunities as we go forward.
So, in that context, and bringing all of these businesses into the fold, you said that you intend to spend more on capex in FY24. What is the number that you're looking at, and where specifically will you be spending?
So we're looking at a number around 3,000 crores plus minus 10% from the 2,200 that we have done this year. We are seeing a lot of legs of growth in India. So altogether, we're looking at 7 greenfields, out of which 6 of them are going to come into India. And of these, 3 are actually in our emerging businesses. So again, as I said, lots of legs, not only for the domestic business, but also on the export side, whether it is on account of China Plus One, whether it's on account of just people looking at more emerging economies to build their manufacturing locations. So that's a big area of focus for us. The other is, versus many of our maybe peer sets, we actually own our land and building. So we are looking at building our portfolio of land and building as we see this, play out from a growth now going forward as well. So both of these will add towards the 3,000 plus minus 10%.
Okay, so taking from that, and you're talking about 3,000 crore of spending this year, you have reduced your debt quite substantially in the fourth quarter, 1,000 crore. And that is being done, as you point out, despite the acquisitions that you're taking, despite certain other headwinds. What is the context? Why? And I would assume that you would have to take more debt in order to have this kind of spending in the new financial year, right?
Which is right. But we would also be deleveraging. We still carry nearly $1 billion of working capital, which we hope to normalize during this year, which should add again towards the deleveraging. The profitability, as I mentioned, should hopefully improve from here as well. So that should also add towards cash generation. So organic part, we still, even after the capex, we believe should deliver. Obviously, inorganic will add some debt on top.
But you are at the lowest ratio in about 7 quarters, is what you pointed out. Does that inch upwards, or do we end the next financial year where we are right now, or maybe even lower?
Hopefully even lower, but the way I would put it is, with the inorganic expansion that is underway, we should still be below 2x debt to EBITDA, net debt to EBITDA.
Fair point. My last point relates to, again, these acquisitions that you are making, the capex, the capacity that you're adding, whether this will change the picture for the business in terms of the key contributors. So you have modules and polymers, which contribute roughly half right now of total revenue. You have a wiring harness that is currently about 30%. Does that ratio change at all?
You mean with the inorganic opportunities coming?
Yeah, exactly. With these new business coming into the fold, with the addition of capacity, how is that picture going to change in the new financial year?
Look, SAS itself is giving us 5 odd billion, which is a modules business. So that will certainly aid towards diversifying our portfolio. The newer ones or the acquisitions in the pipeline, I can't really talk about. But as you know, we have a 3CX10 policy of, no also being more than 10%. And we are on that path of diversifying that piece as well. That is where you're seeing even some of the emerging businesses are actually putting in fresh capexes on growth. Our aerospace business, for example, has shown very high, 30-40% levels of growth. So these legs will help diversify the entire portfolio.
Fantastic. So my key takeaway, gentlemen, and correct me if I'm wrong with this takeaway, is that the downside risks at this point, based on where you see things, are not very much, and you could see significant legs to growth in the new financial year. Pleasure speaking to both of you, and wish you all the best for the new financial year.
Thank you very much, Alex.
Thank you.